Coming up on Market to Market. Washington's failure to enact a farm bill leaves dairy producers in limbo. A barometer of the Midwest economy declines for the third consecutive month. And record-breaking heat fuels lethal wildfires as the drought intensifies in the Southwest. Those stories and market analysis with Alan Brugler next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, July 5 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. American businesses went on a hiring spree last month, making it more likely that the Federal Reserve will slow its bond purchases before the end of the year. The Labor Department reported Friday that employers added a respectable 195,000 positions to their payroll in June. The national unemployment rate held steady at 7.6% as more people started looking for jobs. Average hourly pay rose 10 cents last month to just over $24 per hour. Over the past year, wages have increased 2.2%, while consumer prices have only risen about half that amount. Despite the solid pace of hiring in June, the economy continues to grow sluggishly. It expanded at a 1.8% annual clip in the first quarter, and most analysts expect roughly the same performance this summer. Even less certain are prospects for federal farm programs. While large and complex, farm bills typically enjoy bipartisan support, but not this time. The democratically controlled Senate approved a 5-year, $500 billion farm bill in June with broad support from both sides of the aisle. But the Republican-controlled House rejected its version of the bill. And as the clock winds down to yet another self-imposed deadline, some are concerned that Washington's failure to enact a farm bill could push milk prices above $6 per gallon. Unless Congress acts before September 30th, U.S. agricultural policy will revert to the Agricultural Act of 1949. Why 1949? Because that was the last time Congress authorized federal farm programs on a permanent basis. If the policy is allowed to fall back 64 years, farmers will watch most of their heavily negotiated safety net slip away, while America's dairy producers would see a marked increase in profits. If Congress fails to pass a new farm bill by September 30 or extend key aspects of existing law, provisions kick in that would double milk prices to over $6 per gallon. Most dairy producers see only trouble if the 6-decade law is allowed to take effect. Some farmers are already selling milk at or below the cost of production and are concerned consumers will stop buying dairy products due to inflated prices. Both House and Senate Agriculture Committees proposed changes to the dairy safety net. There were two in the Senate version of the 2013 Farm Bill that passed last month. The first was a margin protection program to pay farmers when the price difference between milk and feed shrinks to a certain point. And the second was a market stabilization program that would require farmers to either reduce the amount of milk produced when prices drop too low or give up a portion of their margin protection payments. USDA would divert the money to purchase and donate dairy products to food banks. Both provisions were originally part of the House version of the bill, but Republicans on the House Agriculture Committee voted to remove the market stabilization program. Ranking member Congressman Colin Peterson, a Democrat from Minnesota, said the change soured several Democrats on the omnibus bill, and the measure failed to pass.
The yeas are 195, the nays are 234. The bill is not passed.
Despite any political wrangling that will inevitably take place, the clock is ticking, and Congress has less than 90 days to come up with a solution. In its latest report on global trade, the Commerce Department reported this week that America's cavernous trade deficit widened in May to its highest level in 6 months. The trade deficit rose to $45 billion in May. That's up more than 12% from April and the largest imbalance since November. Imports rose nearly 2% as demand for foreign-made autos and auto parts jumped 3.1% to a record of $26 billion. Exports of U.S.-made autos and auto parts also set a record of $13.1 billion. But demand for U.S. wheat, soybeans, and corn all declined, pushing agricultural exports to their lowest level in nearly 3 years. And the impact of a sluggish global economy was confirmed this week when Creighton University economists reported a key barometer of the rural economy declined in June. Leading economic indicators for the Midwest declined in June for the third straight month, according to the Mid-America Business Condition Index. The index, compiled by Creighton University, includes data gathered from supply managers and business leaders in 9 Midwest states. Despite the decline, the report projects continued economic growth, albeit slower, over the next 3 to 6 months.
Even though the index is coming down, nothing like what's going on in the national number. Of course, a lot to do with what's going on in agriculture and those businesses tied to agriculture. Even though that activity is slowing, it's still a lot better than what we're seeing in the national economy, and I expect that to continue. We're likely to see growth slowing in the weeks and months ahead, but it's still going to be positive growth. It wasn't as good as we'd like to see, but it certainly wasn't as weak as I feared.
20?
According to the report, a 5% increase in the value of the dollar and slower economic growth in 2013 has lowered inflation at the wholesale level. While prices are not expected to increase in the immediate future, economic optimism has plummeted over the last 3 months. The majority of supply managers felt that spending cuts and tax increases mandated by the sequester have had little impact on their outlook, but most believe higher interest rates could have profound consequences.
The big impact for this month was the interest rate increase. 30-year mortgage rate up significantly, other interest rates up as well, and of course that's going to have some impact on the economy, and that'll be negative impact on the Mid-America economy. Now, even with that, the construction industry is still growing. Even with these higher mortgage rates, I expect the construction industry to continue to expand. And again, the cost of buying a house today in America, the U.S., hasn't been this low in many, many, many years.
Job growth remains positive but has slowed in the first part of the year to 1%, compared to 1.5% over the same time last year. Regional job growth is expected to remain positive but sluggish. And, as is always the case in rural America, much of the economic outlook will be determined by commodity prices.
There's some real issues in terms of agricultural commodity prices coming down. A lot of that we can trace to a stronger dollar, but also we got record yields out there, record crop coming to the market. That's going to push prices down, and that's going to have some negative impact on the businesses that we survey. But again, even with that though, the agricultural sector, by historical measures, is still quite strong.
Officials say U.S. wildfires are charring twice as many acres annually as they did 40 years ago. And the combination of persistent drought, record-breaking heat, and increasing populations in or near wild areas is adding up to increasingly dangerous fires. That point was driven home dramatically this week in Arizona, where a lethal blaze fueled by dry brush and shifting winds in excess of 40 miles per hour resulted in the worst firefighting tragedy in more than a decade. At one point, the blaze advanced 4 miles in just 20 minutes. Firefighters had contained 80% of the blaze by Friday, but not before the flames resulted in a tragic loss of life. The wildfire season of 2013 took a deadly turn this week as 19 firefighters were killed in the line of duty. The elite crew members were overtaken as a quick-moving fire blazed near the central Arizona town of Yarnell. In the deadliest single day for U.S. firefighters since 9/11 and the worst wildfire disaster in decades, 19 members of the Granite Mountain Hotshots perished. Based in Prescott, Arizona at the city's fire department, the specially trained crew would often hike for miles into the wilderness to build lines of protection between people and fires.
You know, this fire was very radical in its behavior. The fuels were very dry, the relative humidity was low, the wind was coming out of the south. It's turned around on us because of monsoon action this afternoon. That's what caused the deaths. It was the change in the radical behavior of the burning fuels. They were just caught up in a very bad situation.
The fire was caused from a lightning strike on Friday and blackened 2,000 acres in just 2 days. By week's end, more than 13 square miles had been scorched and 600 firefighters were deployed in the battle. In many cases, residents escaped moments before the flames destroyed hundreds of homes.
We had to drive through the flames to get out of our gate. It was already that bad. Within 2 minutes, I'd say if we waited another 2 or 3 minutes, we wouldn't have got out of there. It was that fast coming in.
Last year, wildfires charred more than 9 million acres. In the wake of what was the worst wildfire season in U.S. history, the Obama administration is proposing a 31% cut in funding for the government's Central Fire Prevention Program. This week, a bipartisan group of U.S. senators from the region urged the Obama administration to prioritize wildfire prevention. The coalition favors preserving funds for programs that clear potentially hazardous dead trees and brush, and to fund efforts to fight the increasingly destructive blazes. 8 of the most destructive wildfire years in U.S. history have been since 2000. Officials say at least 65 million acres of federal land, an area larger than Oregon, is at risk for fires. Drought, rising temperatures, and an increasing number of people residing in heavily timbered areas are expected to increase that risk. One factor contributing to wildfires is record-breaking heat. The mercury hit 129 degrees in Death Valley, California Sunday, setting an all-time mark for the highest temperature ever recorded in the month of June anywhere in the United States. Las Vegas finished last month with the high of 117 en route to that city's hottest June on record. And what happens in Vegas didn't stay in Vegas this time, as Phoenix endured a 4-day stretch of temperatures above 115 degrees. While the tinder dry conditions are readily apparent in the latest drought monitor, this week's survey revealed continued improvement elsewhere. Currently, 50.8% of the contiguous U.S. is gripped in drought. That's the smallest area since January of 2012. And last year at this time, more than 3/4 of the nation was locked in the worst drought in half a century. Nevertheless, most of America's row crops are in average condition. But cattle grazing areas, particularly the Southwest, are withering. In Arizona and New Mexico, 99% of the pastures in rangeland are rated fair to very poor.
Next, the market-to-market report.
Commodity markets were closed Thursday in observance of Independence Day. And during an abbreviated trading week, grain prices were mostly flat to lower as the trade reacted to the surging U.S. dollar. For the week, September wheat gained 2 cents, while the September corn contract moved 22 cents lower. Old crop soybean prices traded sideways as the August contract gained a penny. Nearby meal prices, however, lost $6.15 per ton. In the softs, cotton pulled out of its recent slump with an upward move of $1 per hundredweight. In the dairy market, July Class 3 milk lost 50 cents, while the August contract moved 25 cents lower. Over in livestock, the August cattle contract lost 7 cents. Nearby feeders advanced by $2.35, and the August lean hog contract posted a weekly gain of 30 cents. In the financials, the euro lost 190 basis points against the dollar. Crude oil soared to a 14-month high Friday, capping a devilish weekly move of $6.66 per barrel. COMEX gold lost $11 per ounce, and the Goldman Sachs Commodity Index gained more than 20 points to settle at 633 even. Here now to lend us his insight on these and other trends is one of our regular market analysts, Alan Brugler. Alan, welcome back.
It's always a pleasure to be here.
And we're glad to have you, Alan. There's been a lot going on the world stage as we look over to the Middle East, as we look at Egypt and the recent events that have transpired there. Talk to us a little bit about how that's playing in the markets, particularly in crude.
Well, you got a big breakout in crude oil prices this week, both the Brent and the WTI that we trade here, basically out of concern that the supplies, either the domestic production, which isn't that large in Egypt, or more importantly, the flow of oil through the Suez Canal. If that gets interrupted, Brent crude in particular becomes affected. That's the European market. There's some question if that were to happen, if the U.S. would start to export some of our crude back to Europe or to the other countries that are affected there. Obviously, that would have an impact here. So we did see a big jump in crude oil prices this week.
And this spike in prices, obviously, it's fear trade. Probably going to continue until things settle down, until Egypt, the riots sort of stop or at least slow.
Well, certainly there's uncertainty,
right.
Okay? And yes, it could continue. Technically, with the breakout, we could go to $114 a barrel pretty easily. So there's potential for it to go up if the uncertainty continues there and in fact, something happens with the Suez.
Mm-hmm. And with nothing on the horizon, we'll just keep trading until we see some news, until that uncertainty becomes certainty one way or another.
Right. Yes.
Well, let's take a look at the wheat market. As we saw, the September contract climbed a little bit this week. Harvest is ongoing. What are your thoughts?
Well, what we're seeing is that the soft red winter wheat, which is traded in Chicago, has continued to show very good yields. Harvest has slowed down a little bit because of the rain in the eastern Corn Belt, Ohio, Indiana area particularly. But the yields have been as advertised with those high crop condition ratings. The hard red winter wheat was drought afflicted, as you know. and yields are a little lower there. You are getting some positive yield reports, but it's mostly from people that had very low expectations. We did get a report from one of the major consulting firms this week that lowered their hard red winter wheat production. They're 50 million bushels below USDA now, and we'll see next week with the USDA report if they agree with that private assessment.
And with that in mind, what's your trend for prices? What's your advice to producers out there?
Well, normally we get some kind of a seasonal low for Kansas City and Chicago wheat during the month. It can happen anytime between May and September, but frequently it's in middle to late July.
Okay.
The market's technically oversold, so I'm looking for a low here in the next week or two. Could get extended if the global situation deteriorates, but we're thinking the low pretty soon here in those two classes of wheat.
All right, and the best way for a producer to capitalize on it, just look at selling?
Well, you lift your hedges when you find that low, try and ride a bounce back into September, and then decide if you need to sell some more.
All right. Well, let's take a look at the corn market. We still have that inverse continuing with July obviously expiring, and the September contract still trading as new crop. We've seen it continue to drop in this recent sell-off. What's your thoughts on folks with old crop corn? Let's talk that first of all, with anything left in the bin.
Well, you're counting on the basis to bail you out there. The September is clearly not following the July. Sometimes you get a little kick up as July goes off the board, but we don't anticipate September would try to go up where July is at. The inverse will be maintained.
Okay.
But what you are seeing is the basis against the September is improving. We were gaining 3 or 4 cents on flat price this week, even though the September board was going down. So the market still needs that old crop corn. Sometime late July, early August, your end user is going to decide he's covered, he's got enough to make it, he's feeding wheat or something, and then you tend to break the basis and slide into a harvest low.
All right, now as we look at new crop potential out there, as now we've got a 4 in front of December corn, what's your advice to producers? How do you handle this?
What I've been characterizing it as is it's a bear market. The bear is running towards $3.80 or $4. We're shooting at him. Okay, there's 3 bullets. The first one he dodged, which was the crop report on the 28th of June. The second one would be pollination in late July, early August. The crop is running late. And in fact, the forecasts right now are for cooler than normal temps for the next couple of weeks, which will not help it catch up. The third one is that you have some kind of an early freeze or even a normal freeze that causes some loss of production. If we miss with all 3 bullets, then we're going to be in that $4 or perhaps even sub $4 range for the fall low. If one of those bullets hits because of pollination or an early freeze, we can still see $5.80, $5.90 prices at some point.
Okay, so for producers who maybe haven't sold as many bushels as they would have liked to, as they were waiting for that crop report maybe to spark the bulls into action, hold off. What's the best way to market in
I
this
think
uncertainty?
the market's oversold at this point. It could go down another 15, 20 cents potentially, but we've got the crop report this week, and of course a tendency to get more nervous as we get into August and into that late July pollination period. So we've recommended you buy 540 D's puts, or at this point you'd probably buy $5 puts to try and put a floor under the price if you don't have enough sold, and then just kind of wait it out.
Until we get a scare, something to potentially push the market higher. Now, as we take a look at soybeans, we're still seeing a fair amount of international demand for beans. How is that shaping prices as we work through the rest of summer?
Well, as you point, we're getting good demand even on old crop. We sold another 100-some thousand tons last week on the export sales report for old crop. And that means that we are going to be very tight on supplies right up into the end of the marketing year. And we will start to see some limited new crop harvest in August, that in beans particularly. But I think things are going to stay tight. You're going to see August be fairly well supported as a futures contract, because getting delivery of August beans means you can still use them before the next marketing year. Okay, corn with September corn, it's too late by the time you get the deliveries. So I think you see some pretty good support there. The meal export sales continue to run very strong. We're at 102% of USDA's forecast for the year in terms of commitments. Mm-hmm. And that means the crusher has to keep trying to buy these remaining old crop beans.
And that's going to continue. We're not seeing any signs of a slowdown in meal demand looking to the future.
Yeah, you're seeing a little bit of resistance. They're trying to
Certainly.
find ways to, blend in some DDGs or a little bit of feed wheat or something to ease the dependence, if you will. Probably the biggest threat to beans would be if we start to see a big import program out of South America that supplements the U.S. supply before the end of the marketing year. And there's definitely been attempts to do that, but they've been kind of stymied by the delays in shipping.
Certainly.
Brazilian shipping still 60 days behind. Argentina about 30 days.
And that's been the story all summer coming out of South America. Now, as we look at new crop beans, what's your thought there?
Well, it's bearish if we get the kind of crop that everybody thinks we have. All I hear is, yeah, they look pretty good. Okay, I'm sure somebody will call in and say, no, they don't here. But for the most part, the crop's in pretty good shape. The private estimates are 3.3 to 3.4 billion bushels. If that happens, we'll have a 250 or 300 million bushel carryout, and that does lower the price estimate. Having said that, the Chinese are clearly having another small crop. They're already fairly aggressively buying new crop. It looks like they'll probably buy at least 6 million tons more this coming year than they did the past year. The rest of the world market is still trying to deal with the balance sheet of the U.S. and South America having big crops simultaneously. But I think it'll be fairly well supported. The long-term uptrend line in soybeans is around $12 or $12.20. We could go below that because of new crop supplies being abundant.
Okay, as we look at exactly how this harvest and how this marketing year is going to play out.
Yeah.
Now, so for advice to producers, again, maybe they haven't sold everything that they'd hoped to. This be a good time to...
Well, we've been actually more aggressive in selling soybeans than we have on corn and wheat, just because of this, the fact that South America is such a big competitor compared to the U.S. At this point, again, my best solution is probably a put spread of some kind, to put a floor under it and then wait for something to happen weather-wise, either here or in South American planting next fall.
Get some margin protection in place and then wait for
Protect the margin while you still have some.
Certainly, certainly. Well, now let's take a look at livestock. As we look over at live cattle futures, we'd been on a bit of a run recently, past 2 weeks. We'd seen a nice rise in live cattle futures. This week seemed to stall out a little bit. How would you interpret what happened this week in...
Well, two things. Well, really three. Fundamentally, we have a problem with cash trade at 119, and the board's now ahead of the cash, whereas for most of the spring we were inverse. We had strong basis. Secondly, export sales have not been that good. The strong dollar's hurting us there. And then third was technical. We got up to the 100-day moving average. The market was overbought after that run-up that you mentioned, and we just need to let a few of the longs out of the market and kind of ease off the overbought conditions. So I think the market takes a little bit of a breather here, but we're still fairly positive, and the market is too. If you look at the futures for December, they're considerably higher than the August or the October. So we're still anticipating fairly tight beef supplies in the second half of the year.
And since we're looking at that premium into December, the market's anticipating continued economic improvement, you assume, to help get us to that premium?
Well, we've got tighter supply,
okay.
Just looking at the way the numbers finish off. But we're assuming some improvement in consumer demand, or at least being able to pay the prices that we're asking. Wholesale beef prices have backed off from the peak. Choice had been up to $210. Now we're down 20-some dollars off of that, and that's making it a little easier to sell the stuff.
All right. Now, taking a look at feeders, we did see some strength this week in the feeder cattle market. How much of that is attributable to having a 4 in front of that December corn contract?
Well, I think that's a lot of it. The equation is if live cattle go up, feeders can go up. If corn goes down, feeders can go up. And in this case, cattle kind of held their own this week, but the corn got cheaper. So you saw that bid into the price of the feeders. To the degree that pasture conditions are improving, that also tends to make you think maybe they'll keep a few more feeders out on grass rather than market them.
Okay.
And so that's part of the equation too, although a relatively minor part.
And speaking of that, what does the supply side look like as we get into fall? How are we doing on the supply of feeder calves throughout the rest of the year? Well,
we know the macro number, which is we're at a 50-year low in cattle numbers, and we know the calf crop was down. Unfortunately, we don't have as good a data with some of the USDA budget cuts as far as the cattle inventory.
Okay.
But at this point, we have fewer animals probably to come into the feedlot. And where that will really become important is if the feeder cow-calf guy decides he wants to hold back some heifers. Typically, when you bottom the cattle cycle, then you have a shortage of feeders because more heifers go back to be mama cows.
They keep them retained, and that's going to cause a shortage looking at the feeder side.
Right.
Now let's take a look at lean hogs. Again, we've had a story of strength recently in the lean hog market. What's driving it, and how long can we expect it to continue?
Well, basically, we've had a real strong move in the pork carcass cutout value, what the packer receives for the major pieces of the hog. And that bottomed back in March. It's a fairly normal pattern to rise into summer because hog marketings decline during this time of the year. It's been given a real boost by bacon demand. I saw the other day there's over 3,000 different menu items that have bacon in them now. And even some things you drink.
That's right. That's right.
And that's translated fairly strong pork belly demand, which is one of the major components off of that hog carcass. That could be the seed of destruction, though, also because the peak of bacon demand typically is BLT season here in the summertime. Your bacon, lettuce, and tomato sandwiches. If it starts to fall off, then we need to see demand for hams or loins or some other component pickup.
Okay, so it's kind of all hanging on bacon, more or less, at this point.
Yeah, we're somewhere close to a top in the hogs between now and August for sure, and just from seasonal standpoint.
All right. Well, thank you so much, Alan. Appreciate you being with us tonight.
My pleasure.
That wraps up this edition of Market to Market. But if you'd like more information from Alan on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine the impact of the government's latest estimates on supply and demand. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.